In the previous lesson, we have discussed that there are many players in the stock market, each one having a different purpose, a different intent, or a different agenda. So the first and the most important player in the stock market is the investor. Investor is the primary player in the stock market. And what is the intent or the interest or what is the agenda of an investor? When an investor purchases a share of a company, when he puts in his money, he is actually wanting a part ownership in that business. He buys a stake in the business and he wants that business to grow so that his investment grows. And therefore, before he puts in his money, he studies the financial statements and does lot of research about the financial status or the worth of the company. He does not blindly put in his money into any company. And he is willing to wait patiently and see his money grow at a reasonable pace. He is not in a hurry. A mature investor, a knowledgeable investor, he would be satisfied with about 14 to 16% annual growth of his money. Alright? And how does he earn from his investment? He earns because of the growth in the value of his stock. He buys the stock and after some time the value or the market price of those stocks increase. That is called as the capital appreciation. And he also expects some dividend from the company. On and off, periodically, whatever profit the company earns, a small portion of that profit the company would distribute as dividend. So the investor is also looking forward to earn a periodic return in the form of dividend. And he also expects some bonus shares, some rights issues. Now these bonus shares and rights issues, they do not directly add to the value of his investment, but indirectly they help. We will see after some time during the course as to what these bonus shares and the rights issues are. Alright. So an investor is supposed to be the most important and the primary player in the stock market. But unfortunately, he is also one of the most insignificant person as far as the stock price movement is concerned. As far as the price or the market price of the shares are concerned, an investor is not able to influence that very much. In fact, a true investor is not worried about the stock price volatility. Volatility means the price going up and down. So if you are an investor, you would normally not be worried about the price going up and down as long as in the long term the price goes up. Alright. The second most important person in the stock market is the trader. What is a trader or who is a trader? What is his intent or the interest or what is the agenda of a trader? A trader is not interested in any ownership in the business. When a trader buys a stock or a derivative, he is actually not interested in any ownership in the business. He just wants to buy when the price is less and sell it off when the price is high. Or at times, he also sells first and then repurchases when the price is low. This can be done with the futures and options or the derivatives. So try and understand the difference. An investor first buys the share, he purchases them, he waits for the price to appreciate, and then only in the long term he would sell his holding. But a trader is not worried about the price. He actually does a trade both the ways. When the price is low, he would purchase, and very soon when the price increases little bit, he would sell them off. Or when the price is high, he would sell them off and repurchase when the price gets low. So he earns money both the ways. He is actually not concerned with the growth of the company, whether the company is growing or not growing, what are the sound fundamentals of the company. He's not bothered about that. He is just bothered about the price movement. All right. And he is not willing to wait for long. He wants to frequently buy and sell, capitalize on the price movement rather than the true value of the shares. And he therefore is not interested in the financial statements because he is not interested in any ownership or a stake in the business. He is not worried about the financial statements, whether the company is financially sound or not good. He is not worried about that. He relies on the technical indicators, technical analysis, candlestick charts and patterns, or some buy and sell signals. These technical analyses are basically conveying a situation of demand and supply. They do not convey the true value of the shares. They just indicate whether the price is likely to move up in the short term or come down. And therefore, a trader would rely on these things rather than the financial statement. And how does a trader earn from his trading? As I have told you now, that he earns by buying and selling or selling and repurchasing with minimum amount and in the minimum shortest possible time. He does not want to put in a lot of money. He puts a small amount of money and he uses financial leverage, borrowed money. What is financial leverage? That I have explained in one of my other courses, that is about the fundamentals and concepts of finance and investment. You must understand what is financial leverage, but just for a small clarity here, financial leverage is nothing but using borrowed money and taking a higher risk. And that is normally done when you trade in futures and options or the derivatives. So a trader earns money by taking financial leverage and buying and selling at a high frequency. He is not concerned with the dividend, bonus, rights issue and such things unless these things affect the price or these things cause a price movement. And therefore, a trader's interest and the method of playing in the stock market is entirely different from that of an investor. Both of them are having different intentions. Their method of playing is also different. While an investor wants the price to steadily go up, a trader wants the price to fluctuate. He wants the price to move up and down. If the price does not move up and down, then the trader will be out of business. All right. And when we talk of a trader, then a trader is normally broadly of two types: a person trading in stocks or trading in derivatives, that is the futures and options. Some people trade in both. Normally, the stock traders are small time players. For a stock trader, trading in stocks is normally not his profession, but a source of second income. Normally, he does it as a pastime. But a derivative trader causes a major influence in the stock market. For a derivative trader, trading normally is his profession and he does it as a whole time activity. And both these people, whether he is a stock trader or a derivative trader, they fall under three categories: a positional trader, a day trader, and the third category is called as a scalper. What are these? You must try and understand, and then you will get a comprehensive understanding of how the stock market functions and how people play in the stock market. First is a positional trader. A positional trader actually buys or sells. He takes a buy position or a sell position and waits for a few days or maybe a few weeks also to exit with a good profit. Alright. If he has bought, then he will wait for some time till the price increases and then he will sell it off. Or if he has sold first, then he will wait for the price to come down and then he would repurchase. And how does he manage his risk? He manages his risk with a combination of futures and options with the help of derivatives. and he does not have to constantly monitor his position. He takes a position and then he relaxes. He can monitor on and off in between, but he does not have to sit in front of the monitor the whole day. Alright? So he takes position with a balanced view. He manages his risk properly, a positional trader. Alright? But a day trader is in a hurry. He takes a position during the day and he wants to exit or square off during the same day. He does not want to keep his position overnight for the next day. What he does is, if he has purchased in the morning, then by afternoon he would want to sell it off even at a low profit. Or if he has purchased or if he has sold in the morning, then he would want to repurchase by afternoon and get out of the trade. He does not want to keep his position till the next day because he is not sure of what will happen in the opening trade in the next day morning. And how does he manage his risk? He manages his risk with stop loss trigger price. He puts a stop loss to his trade so that if the price movement goes against his perception, then he automatically exits the trade with a loss, with a small loss. So this person, a day trader, is happy with a small profit or a small loss. What is this stop loss again? In our other courses where we have discussed about the futures and options, we have discussed about this in detail. Alright? But this is nothing but a technique of limiting your losses. Got the point? And as I have told you, this person, the day trader, has to constantly monitor his position. He does not have to sit in front of the monitor constantly if he has put a stop loss. But still, he has to spend most of his time in front of the monitor or the screen when he is trading. And the third category is the scalper. You know what is scalping? Scalping means taking out a small layer from the top. Like this person, he is scalping the butter with a knife. Alright, taking out a thin layer very quickly. So what a scalper does is, he takes a trade for a few seconds or a few minutes or at the most for a few hours, maybe a couple of hours. He does not even wait till the afternoon or the evening. He takes a trade, if he has bought it, he will sell it off immediately in a few seconds or a few minutes if the price increases marginally. Or if he has sold, then he would repurchase in a few minutes as the price comes down. Alright? And if he is incurring a loss, then with a small loss he will exit. He will do this several times in a day. Many times in a day he will do that, and he remains satisfied with very small amount of profit. For example, if the positional trader is expecting a couple of $100 as profit, a day trader would expect a few dollars as profit. But a scalper would be satisfied with a few cents. He doesn't, bother about big profits. During the day, many times he will get in and get out of the trade, keep earning a few cents, so that in each trade, if he earns a few cents, then by the evening he would have a few dollars in his profit or in his pocket. Alright? And how does he manage the risk? He manages the risk by exiting with a small loss. And this person cannot move away from the screen or the monitor when he is trading. Constantly he has to keep looking at the screen so that the moment price goes in his favor, he would exit the trade. If he takes a nap for a short time and if the price goes adverse, then he will be in a big loss. And therefore, he has to be in front of the screen constantly. So now we have discussed about the investor and the trader. In the next lesson, we shall talk about someone called as an arbitrator and also about a hedger or what is hedging. Alright?